All right, David Settle here from Market Scholars. You'll see in the top right corner of your screen a link to subscribe to our site, to marketscholars.com. A lot of fireworks we had early on in this week, finishing with a little bit of a whimper. So is this kind of neutral pattern telling us something about what to expect next week? Or are we now back on this trend? So I'm going to break down the patterns, the volume, and different indicators and see what we should expect from the short term and how that impacts this new intermediate and long-term trend that we're waiting to kind of get going. And I'm also going to take a look at a stock that looks like it's poised for a potential breakout and how to trade that. So let's go ahead and get started. Today is Friday, April the 27th, 2018. This is the Market Outlook from MarketScholars.com. Thank you very much for watching tonight. Welcome to those of you who found us for the very first time, who are watching us for the first time. Keep coming back for more. Subscribe to our YouTube channel by mousing over the logo in the bottom right corner of this video and then clicking on that red subscribe button. Also, click the thumbs up icon that's down below the video. That tells me two things. Number one, it tells me that you liked the video, you got something out of it. Number two, with one click, it tells me you want me to do the video again tomorrow or Monday and keep doing these videos day after day. It's a really easy way to give us feedback. Comment on anything that stands out to you from tonight's video down in the comment section below. And then join our daily Market Outlook email list. I've highlighted the link in the video description that will allow you to do that. Follow me on Twitter for more content like this throughout the day. My handle's up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join our Market Outlook community on Facebook. Again, a link in the video description that will take you there to do that. We take a look at the S&P 500 with the market forecast indicator, and you see that the intermediate line is starting to turn up a little bit higher, just a smidgen. So it shows a bullish posture. But again, it's not very bullish. We were just that bearish, and we're right around the midpoint of the chart. We have to get back up above 50 for it to have that run that we expect. So we're, keep grain of salt on how bullish this is. You also have this downward trending slope line that we haven't crossed up above yet either, and that's kind of like our tipping point of saying, okay, now we're going to get this extended run. But positive sign that we came off a higher near-term low point. Positive sign that you came off these long lower shadows. You closed above the high of the low day yesterday. Not quite up above. When you get long bodies like this, I mean, long lower shadows are great. Those are bullish. But you get these long bodies, we have to get through those. I mean, that's a big down day, all in one day. From a psychological standpoint, we started the day higher on that particular day. So we traded in that area before coming down. So that area, there's a resistance in that area. There's going to be a lot of people getting back to break even in that area. So, there's going to be a resistance, small resistance intraday, but a resistance nonetheless. So, we're heading back up into that area now again. So get above that line more importantly, and you have a chance for a higher near-term low. My guess is that we won't, on this current near-term run, because the intermediate posture is not very bullish, it's just kind of getting going again. We've been bearish. The pullback went past the 38%. If we would have bounced off that 38% Fibonacci line and then went higher, then I would have felt good about the next near-term rally getting up to higher highs and busting through there. The fact that we dipped here and went to the 62% Fibonacci makes me expect that this current near-term run will probably finish here with a slightly lower high, probably hit up against that resistance, maybe be in this little area right here within another day or two. Then roll over after just a few days above 50, so not quite that 5 or 7 to 10 that you expect. Roll over from a slightly lower high, then form a slightly higher, again, near-term low, so kind of like form a little triangle here, and then break out to the upside and start this run. And again, why do I expect to break out to the upside and not to the downside? Because market sentiment's low, and we expect that that to develop into a low point and bounce up higher. There's a lot more support down here than there is resistance up here. Yes, there's resistance up there, but a lot more support down here than there is resistance up at the top. So, again, you think about low pressure versus high pressure, and you're attracted to the low pressure more than you are the high pressure. So it has a tendency to want to move in that direction, and so doesn't mean that we can't drop down, because again, news can come out that's unexpected that can cause anything. But and that's kind of why I expect that we'll move more to the upside than we will breaking this big pressure, this big amount of volume here on the downside. But of course, again, near-term line getting into reversal zone. Like I said, it might spend another day or two going up towards that resistance. I don't think we'll get above that near-term high here on this near-term run. I think we'll form a slightly lower high, maybe even an equal high, but probably lower high than that. Then a higher low, then the triangle, then the breakout on the S&P 500. Another reason why I tend to lean more towards a bullish breakout is because, like I've mentioned before, we already have broken out on the Russell 2000. You can see it did not pull back as deep on its Fibonacci retracement, so it still offers the opportunity for a move up to higher highs. You can see its near-term line now just getting above 50, so not quite as bullish in the short term. From a near-term line perspective, you take a look at some of these other indexes. The Dow Jones Industrial Average also has that near-term line getting above 50. An intermediate line starting to roll over or roll up. The Nasdaq had the stronger day at the outset, with the earnings results overnight, Microsoft and Intel and Amazon, but you can see pulled down by the end of the day. So kept the near-term line from being really at the much higher levels where it was when we were at 7,200. Regardless, still a much higher high and obviously a slightly higher low. And we didn't close back down at the low. We didn't close below that, back down here. It still finished slightly higher. So not as bearish of a candle as it could be there, but also not that bullish. Another sign that I think, too, in the short term, will peak at a lower high. And then bottom out with a higher low and kind of triangle our way into a breakout move to the upside, and where the intermediate line can take off and move higher. Before we hit the rest of the video, I just want to remind you that if you're watching this on our blog, and if you're not watching this on our blog, you can get there with the link that's up here in the top right corner of the video player. You'll see it popping out there to visit our blog. But you can see the video there in the blog. You can change the resolution, change the speed, as well as see closed captioning if you like. There's also the links to tonight's Market Outlook tweet, the Facebook post. So what I want you to do while you're watching right now is make 3 clicks. The first click is to like the tweet here. You can also retweet it if you like, but at least like the tweet by clicking on that heart. Like the Facebook post by clicking on that thumbs up, and you can also click here to like this particular blog post. So clicking those 3 things tells me that you want me to keep doing these videos day after day, me and Brandon, to keep doing these videos. It's a 1-click way or 3-click way to give us feedback. Very, very simple, very easy, very quick. It also tells Twitter and Facebook that you want them to keep pushing you my stuff. And then, again, the benefit I get out of it is it tells Twitter and Facebook that they should share this with all of my followers and make sure all of my followers are getting this information. Now, of course, we also want you to participate in the forums. And again, there's a link in the top right corner that's popping out that has a link. You can click on that to get straight to the Market Outlook forum. Remember, there's a promotion going on right now until May 5th, so we still got a couple weeks, or a little bit more than a week. Every time you create a new topic in the forum, every time you reply to somebody else's topic, you get entered into a drawing for one of 5 gift cards, Amazon gift cards. So make sure you are participating there. Now you can see, again, we finished below the 50-day moving average. So we've been trading right around that 50-day moving average here for the last couple of weeks at the close. And again, long lower shadows are bullish when you see that, but no arrow yet. No, you get that green arrow when you get back above the 50-day. You can see the 200-day still rising. We held that for support. And again, breaking up above that downward sloping line will probably most likely start to bring that 50-day moving average up again. And that's what happens. You can see it will go up and down. And as that 200-day moving, especially as it starts to slow down, you'll see it will go up and down a little bit. Here a little bit more because we were so far away from it. So we pulled back a little bit more than what you normally see. But you know, don't be surprised if we don't go up a little bit more now, but not to a high, you know, to a lower high on the MACD. So it won't go as high as this one, and that's what happens when you slow down, and every new peak ends up being lower and lower there. You look at the 3 green arrow chart, you can see, you know, you got the 1 here, so we're back up above the 30-day moving average, and the 8 and the 17-day is also above the 30-day moving average. So that's actually a positive development to get both those short-term lines. It's just a little bit above, and they're both converged. They're pretty much all 3 of them converge, and you can see the MACD and its moving average is right at the midpoint. You really can't be more neutral than that. And then the stochastics, you can see, is also right at the midpoint of its chart, and looks like it's starting to slow down a little bit in terms of this decline that it's had. So, you know, you remember the intermediate lines also just a little bit below 50, so we're pretty darn neutral, and I expect that we'll continue to be pretty darn neutral from a technical perspective, not from a news perspective, from a technical perspective for another couple of days before getting more of a breakout after a little bit more of a coiling action. Interestingly enough, after all that earnings and GDP out this morning, by the end of the day, we just basically went sideways. I mean, we gapped higher, pulled back, bounced up, and managed a really small range. So, what, less than 2 points range at the top end of yesterday's range. So relatively positive there. And then you can also see above last week's low point. So we didn't close after trading pretty far away from last week's low point. Early on this week, we made a nice strong rally to get back up above it and stay above it. So more neutral. It could have been a lot more bearish, but it ended up being pretty darn neutral for the week. And you can see the volume today and yesterday both tapering off. Again, another sign that I think will taper off to a lower near-term high because the volume's already tapered off as much as it has. As you know, to less than a 2-point range with 56 million shares traded. You know, there's your range. That's how it fits with the average. And then the 50 some odd million shares trading, I mean, that's down here. That's that's way down here. That's about where my cursor is here. So that's way below that average too. Remember, these lines dropping are bullish. Excuse me, they're not bearish. It's bullish when you get those lines dropping, and there's a long ways to go. Volume can stay flat for a long, long time. The range is a long ways to go for that average to start to fall down, which means we have potential for a bullish run, especially considering how low market sentiment is. We take a look at the volatility index. See how far, how fast it's pulled back, you know, getting up to 20, hitting that resistance, pulling back down to 15. You know, again, don't be surprised if we don't bounce on any kind of near-term weakness back towards that 17.5, but form a lower high at that point and then meander around 12.5 to 15. If we get an extended intermediate run and start to build into more of a longer market sentiment line run. That's on a absolute basis. On a relative basis, you can see the VIX has dropped to the lower, with all this earnings finishing, volatility has dropped. Started off really high yesterday, 1.05, which is the extreme to the upside. Closed back in the neutral range yesterday, closing at the bottom end of the neutral range. So still not bullish yet. You have to get below 90 and stay there. See, we haven't closed below 90% for a long time, since the middle of March. We were just a little bit below 90, so a little bit there. But then we got back up above on this pullback at the end of March and April. So we haven't quite closed back below 90 yet, and especially closing below 85 where we were most of the really, you know, the end of that bullish run, that bullish market sentiment run. So not quite there yet, but you can see how, you know, if we're going to get any short-term weakness, we'll probably get a move like these right here back to 95, but staying in that range, maybe a little bit above 95. Like really much all four of these days, because that one finished below 95 too. Before making the run and getting below. And when it gets below 90, then you know most likely will coincide with a break above that downward sloping resistance line in the S&P. Then we'll be bullish for a longer extended period of time. And now, when I say that, I'm not talking about like months. I'm just talking like, you know, like the last year-long market sentiment rally that we've had. You know, that started at the end of 2016, ended at the beginning of this year. I don't expect another year-plus market sentiment run, but you know, the normal 6 to 9 months, that's definitely more in the cards. That's fueled by a few 1 to 3 month intermediate runs. And this would be our first one if and when we do break below that level. All right, when we take a look at what's driving the price action, the biggest news today is the GDP report, and GDP report beat expectations. You can see the consensus was for 2%. We got 2.3%. As most of you know, been watching this video before, I like to use this website to break those numbers down. It's very good, a lot of really good information. You can see that the total GDP growth here was 2.32%. You can see it all broken down into its different components and what really kind of led the charge higher. You can see a lot of people put a lot of stock in the fact that consumer goods growth was actually negative, so it actually contracted. Keep in mind that in the first quarter, it almost is always lately very, very low. I mean, it's been a few years since we were even close to 1% growth on that. So yeah, it contracted, but it almost contracted the quarter, last year in the first quarter and the year before that in the first quarter. So that's usually a pretty weak sign. The fact that the fixed investment dropped from 1.31%, but you can see, that's, over the past year, that's the second strongest number that we've had. And that's actually what kind of helped push us through there. Inventories were strong at 0.43%. You can see we don't get very many strong numbers. When consumer goods growth is high, you don't usually get strong inventory growth. In this case, it was negative, and so you got some inventory growth. So that's temporary, and that added to. And of course, imports growth was dragged it down a little bit. We'll always drag it down, but it didn't drag it down as much as that year. So, again, without that 2% drop, you would have had 4.88% if import growth was negative. So this kind of shows you that has a negative import growth, actually has a negative impact on GDP because we're buying other countries' goods, right? So it didn't have as much of a negative impact, so it lifted it up high. It lifted the overall number higher, and of course, the deflator, deflator that they use here also impacted that and raised it by about 0.5%. So you can kind of get an idea that it was strong growth, but it didn't, the interest rate hike expectations didn't rally because of that. And if you take a look at the yields here, if you look at the 30-year yield, it actually dropped. And remember, this is the yield that kind of reflects economic growth expectations, that long-term yield, whereas the 10-year yield is more geared, and especially even more so, the 5-year yield is more geared towards interest rate hike expectations. So you can see it pulled down a little bit less, but that 30-year yield dropped down. There's 1.8 basis points on the 5-year. The 30-year dropped down half of 0.5% there of a point, 0.5 of a point, 1.5%. So much bigger decline, and it just kind of reflects this notion that our economic growth expectations going forward. It was a good quarter, it was a good number here, but it wasn't a strong enough number to say that we're going to continue to raise expectations for future quarters, even though the expectations shouldn't have been very high for this quarter. Like the expectations for the Jazz to win Game 5 against the Thunder. I've been using that analogy a lot because I'm a Jazz fan, right? And we're in this big playoff series right now. But the expectations for that were high. Were not high for the Jazz to win Game 5. They had to go back and to the Thunder, so they lost. They lost a 25-point lead in the second half, and they ended up losing the game. But you don't expect them to win in that scenario when they're the road team and it's back against the wall for the higher seed. And so same thing. You shouldn't have had high expectations for GDP growth anyway. And that was actually because of the seasonality, and that was actually a pretty decent number according to those expectations. And you can see that the economic surprise index is still very strong, especially relative to what we see elsewhere, and that's what matters the most. We'll get the first estimate from the Atlanta Fed for second quarter GDP, and don't be surprised if it ends up being a very, very high number. And if it is a very, very high number, don't be surprised if it doesn't get cut in half by the time the actual number comes out, which is kind of normal. So by the end of the week, just looking at the week that was here, the dollar ended up pulling back some of its gains, but ended up the best performing asset class. You can see bonds rallied with yields pulling back a little bit, pulling back quite a bit in the last few days. And gold struggling with the strength in the dollar this week, strength in the dollar. You can see stocks had that low point pulled down by emerging markets. Off of that low point into the close, stocks were up 2.25%, led higher by emerging markets. You can see bonds up with small caps in developed markets, and the dollar still up, pulling back some of its gains, and high yield. And just looking at just today, with strong GDP coming out, long-term bonds had the best performance. Again, those economic growth expectations, that's kind of what they reflect. Emerging markets had a good day too, with a little bit of relative weakness in the dollar. And you can see U.S. stocks kind of flat by the end of the day, really kind of flat at everything. Even crude oil, which is one of the more volatile asset classes out there, ended up pretty darn flat for the day. So kind of a quiet end to the week, especially when you consider decent GDP and a historic agreement to potentially by the end of the year in the Korean War, taking away what has been some geopolitical risk. The market has responded negatively to things that have come out over there in terms of nuclear missile tests and things like that, and so. Considering that that's a big risk that's been taken off the table, potentially, a high likelihood of it eventually being taken off the table, the market kind of took the Friday off and had an early start to a nice spring weekend. You can see here for the week that was, from a sector rotation standpoint, you can see utilities and real estate, those two real sectors that just have been struggling. They've had a great week this week, up 2.5%, both of them, more than 2.5%. Healthcare also rallying. Materials and industrials, economic growth sensitive areas, lagging, in fact, falling. Materials down 2%, industrials down 3.25%, and a week that the market was flat. And technology, even with today, falling. So you can kind of see, again, why yields, long-term yields are falling too, with this number. And that was even before the GDP number came out. You can see that with yields pulling back, your safe haven areas did really well. They've been pressured for so long. They've done really well. And there's your energy sector, which has had some really good gains lately, over the last couple of weeks. Pulling back, giving back some of those gains. You can see it better here on this chart. So, pulling back some of its gains, whereas some of these lagging sectors are coming up. So when you see this, obviously, it starts off at zero on any time frame you look at, and then it will expand away, and then they'll start to pull back. So now we can expect relative weakness in crude oil. We can expect some relative strength in some of these safe haven areas. Not that they'll start to trend higher, but at least in the short term, show some relative strength. And if we get some short-term weakness, according to market forecast, in the next day or two or three, and come off of this slightly, maybe even like an update Monday and then a Tuesday, so again, we can go up a little bit more. I just don't think we'll get up to a higher near-term high. And if we roll over, I don't think we're going to go down to a lower near-term low either. I think we're going to coil. And if we do kind of coil into some weakness, expect some relative strength in these areas, some relative weakness up, and these real big outliers. All right, so earlier today in my technical analysis class that I taught on MarketScholars.com, I introduced this directional movement index down below as an indicator to look for signals with a few trade ideas. And today, in our market outlook video, I wanted to take a look at a stock that's also showing a little bit of a breakout here. You can see the way this oscillator works is it looks at where the highs are in relation to each other. And we can see that green line, the positive directional movement, the directional index is moving higher. So, it's crossing up above, where it was below at 24, getting up to 35 today. And the average of those two, because we've been so flat, the average directional index, the black line, got below 10. It doesn't get below 10 very often, which means we were really sideways for a long time. That is about as flat as, I mean, that doesn't look very flat, but 65 to 67.5, a 2.5 point move on a $65 stock. It's a very sideways trading range, and it looks like we're trying to break out here. Not as much volume today, but trying to break out. So it's not necessarily a stock that we look to buy, but there's and you've got some resistance in the $70 area, but you can see we've got some support at this 67.5, this kind of midpoint of this range that we are now trying to break out of, with this line, the green line, getting up to a higher level than even we had over here when we had those that run. You notice we never got above 30 on the positive. So the index is telling us there's an opportunity here that we haven't gotten yet during the sideways run for a potential breakout. So, but not, again, not as much volume, and you can see we're also breaking through the upper Bollinger Band a little bit, just a smidgen up to 101 on the %B down here, and the band width set suggests that we could get a little bit of a run too if we were to get the bands to expand a little bit more up to that 14 area. So there's opportunity here, and so okay, well, without being too bullish, we can just look at that June expiration, sell 67.5 with a 30 to 40 delta, buy the 65. 58 cents is what we normally try to get. 56 is pretty darn close enough. And then you analyze that trade, get rid of some of these other older ones, analyze that trade, throw the break-even price on there, set the slices to the break-even, and there we go. So if we were to break back now below that moving average, kind of negate this push and break back below, then we'll just take, a 50 some odd dollar loss. Similar to what we're trying to get, a 1-to-1 reward to risk ratio, but a high probability from a volatility standpoint of staying up here. And of course with the indicator, the signal that we're getting down here as an opportunity. So bullish trade, not as bullish. We do have earnings coming up. You can see if I were to pull this a little bit more over, there we go. So the earnings is on June 27th. That will be after the expiration date. So we don't have to worry about that hitting. You can see, in fact, even back here you have higher volatility in the July, which you should. There's almost 35 more days, but that's, there's going to be other weekly options coming after this that will have a higher volatility than that 22%. So as always, that wraps us up for today. Thank you very much for listening to tonight's video. Hope you got some good value out of it. Keep coming back for more. Remember to like, subscribe, and comment down below on the YouTube channel. Follow me on Twitter for more content like this throughout the day, throughout the week. Also join our Market Outlook community on Facebook. You see the link in the description below. Remember, you also can subscribe to MarketScholars.com. In the top right corner of your screen, you'll see a link to be able to do that. Have a great weekend, everybody. We'll see you all on Monday.